Silver is like somewhere between 77 and 85. I'm intelligent, but I talk about gold and silver and I'm wasting my time with these little trinkets. Still expect a huge sell-off in everything, including gold and silver, but it would last maybe, I wouldn't sell here because anything could happen here. We go to 100 tomorrow, we go down to 50 tomorrow because the Comex could jack up margin rates to 100% if they wanted to, which means that you don't get any leverage exposure. Let's say you're a hedge fund and you own contracts, long positions in silver, 5,000 ounce silver contracts on, let's say, 30% margin. So that's 70% of the cash you don't have to put into that. And then all of a sudden they're jacked up to 100%. You don't have the cash. You got to sell those like immediately, or they'll sell it for you by force. It has nothing to do with the inherent value of silver or anything like that. It could lock up the entire futures market, and that's when the Comex would have to act, not out of any malice or anything towards silver stackers, but for their own survival, which is exactly what the LME did when nickel exploded. They reversed trades because they had to. So be careful. Where are we now? Silver's like somewhere between 77 and 85 or 77 and 82. The fact that I don't even know where it is within $5 tells you exactly where we are. I've lost track. I'll tell you what it's like over here. I'm getting a lot of calls from people who don't usually talk to me asking where they can get silver. One guy called me who has never called me before. I had one conversation with him about central banks. I was with him with his daughter and then son-in-law over Shabbat dinner a few months ago, and then I discovered that he has some central bank consciousness as to what's going on, but then he was like really alarmingly worried that if he makes the silver order now and at a company that imports silver here in a lot, that they wouldn't go through because China's about to shut down or something like that, or they're going to shut down exports, and he was really worried about getting a supply. So I was like, look, just make an order, relax, you can do it. You'll probably get it. If you don't get it, they'll give you your shekels back. Just a lot of nervousness and people looking at me a little bit differently.
This is what the early stages of a trust breakdown actually look like. Confusion replacing price precision. As Rafi Farber points out here, the inability to track silver within a narrow range isn't ignorance, it's volatility born from fear. Historically, spikes in inbound retail demand often precede supply chain anxiety, not because shortages exist, but because confidence cracks first. We saw this in 2008 and again in March 2020. Global silver inventories reported by exchanges still appear adequate, yet perception is driving behavior faster than data. For everyday investors, this matters because panic-driven buying usually arrives after institutional positioning is already set. And as Rafi Farber hints, when friends stop laughing and start calling, markets are no longer quiet.
Usually it's like, oh, I'm intelligent, but I talk about gold and silver and I'm wasting my time with these little trinkets. But now it's like they're looking at me and they're less laughing. And I feel kind of bad because I know none of them have the money to stack anymore because it's already like $80 an ounce. I mean, they should have done it when it was 20, but no, that's the thing about hyperinflation. Nobody goes all in until everybody goes all in, and then it all happens at once. So I don't think we're on the verge of hyperinflation like within days, because we still have to have one last major bank bailout or whatever the financial crisis is going to be. We haven't had that yet. So once that happens, I still expect a huge sell-off in everything, including gold and silver, but it would last maybe a few days or maybe in just a few hours. I don't even know. And then the Fed to print like something like $10 trillion overnight, and that should be the end. After that, it should be the end game, and I don't know, a few days to weeks after that. So we might have one more shot here, but we're getting to the 2-minute warning now.
This paragraph quietly exposes a brutal truth. Most people only protect themselves once protection becomes unaffordable. Rafi Farber describes a classic late-cycle behavior pattern, where disbelief turns into regret almost overnight. Historically, major liquidity events, or 2008's TARP or 2020's $4+ trillion Fed expansion, were preceded by asset sell-offs, not straight-line rallies. Investors should note that even in crises, metals often drop briefly as margin calls force liquidation. The danger is mistaking price dips for safety rather than stress signals. As Rafi Farber implies, the 2-minute warning isn't about timing perfection. It's about whether portfolios are prepared before policy panic replaces market logic.
Certainly, I think, and coming from your perspective, I mean, it sounds like we're pretty close to the end game in your view. A lot of people might be looking at the price of silver, around $80 at this point and saying, well, is it too late to jump in? I guess my perspective, it's really determined by what you see happening in the future and also what your strategy is. If you're just trying to get insurance to, weather the end game that you see coming, it's really never too late, right? Because you just need something of real value. If you're trying to time the market and get in, get out, then yeah, maybe you could see a bit of a pullback from here. But your perspective on that, like, what is your strategy here? Do you really care about price fluctuations?
I care about it a little bit because I do have a very limited amount of options. I mean, look, I run a newsletter. I can't just constantly talk about monetary philosophy. It doesn't change. So I do have to trade a little bit just to keep people interested on that level. But I don't, it's like a cherry on top. I wouldn't even say the whipped cream. It's less than that.
This is the rare moment where strategy finally matters more than prediction. As Rafi Farber frames it, silver isn't a trade first. It's insurance that only looks expensive after risk has already risen. Historically, assets held for protection behave very differently from assets chased for return, especially during Fed tightening to easing transitions like 2001 or 2020. Tactical trades can add yield, but they also introduce timing risk most retail investors underestimate. The key distinction here is intent, hedging versus speculating. And as Rafi Farber subtly reminds us, price obsession often distracts investors from the structural problem they were trying to hedge in the first place.
So, for example, I spent like a few $100s when silver first broke 50 on October 9th. I said to my subscribers, look, you may, if you have a few extra $100 or something, you may want to get a few SLV call options on, let's say, something way out of the money, like I don't know, whatever the strike was, because once silver breaks 50, it could go much higher very fast because it's done that before. So we did that, and it made a lot of money. And I already sold out of most of that position. I still have like just a handful left. So I care, but I'm not like stressing over it. I made some nice profit, and that's all. But if you're gonna go all in on derivatives and make a bet on how fast silver's gonna get to some target within a certain short time period because you have $50,000 of debt to pay off and you're relying on that, it's a bad situation, because that's what the silver short sellers are looking for. If they can get you squeezed out, they'll do it. I don't know if they can, but look, we're in a theoretical. We have to acknowledge, as exciting as this is and all the positive emotions that bring up, we have to acknowledge that we are in very dangerous territory here.
This is where retail enthusiasm quietly collides with institutional mechanics. Rafi Farber highlights a key asymmetry. Short-term leverage benefits professionals far more than individuals with real-world financial pressure. Data from the CFTC consistently shows retail traders are net losers during volatility spikes driven by margin changes. Derivatives amplify emotion faster than fundamentals, which is exactly what large players exploit during squeezes. The risk isn't being wrong on silver, it's being forced out before being right. As Rafi Farber warns here, dangerous territory isn't defined by price highs, but by how much leverage the system allows before pulling the rug.
Because the Comex could jack up margin rates to 100% if they wanted to, which means that you don't get any leverage exposure. What is it now, like 40%? I don't know. It's I think it's measured in dollar terms, not percentage terms. Last I saw was like $30,000 or something. could be off on that, but they could jack it up to 100% if they feel really threatened, and then that forces a lot of people out of positions because they suddenly have to fund. Like if you own, let's say you're a hedge fund and you own contracts in long positions in silver, 5,000 ounce silver contracts on, let's say, 30% margin. So that's 70% of the cash you don't have to put into that. And then all of a sudden they're jacked up to 100%. You don't have the cash. You got to sell those like immediately, or they'll sell for you by force. This is all technical stuff. I mean, there's nothing to do with the inherent value of silver or anything like that. It's just we're still in a derivative system. They still got a lot of levers to pull here. And you got to be careful. So if you're a stacker, keep stacking. Or if you have enough, stop. But I wouldn't sell here because anything could happen here. Anything. We could go to 100 tomorrow. We go down to 50 tomorrow. I really have no idea.
This is where people mistake market moves for fundamentals when it's really about who controls the rulebook. Rafi Farber is pointing out that margin hikes aren't price discovery, they're pressure valves. And Comex has used them repeatedly during moments of stress, including 2011 when silver collapsed after rapid margin increases. A forced jump from roughly 30 to 40% margin to 100% instantly liquidates leverage players, regardless of silver's real-world supply or demand. That's not bearish or bullish, it's mechanical. For investors, this means volatility can spike without warning, wiping out paper positions while leaving physical holders untouched. The real risk isn't silver's value. It's being trapped in a system where leverage is optional for exchanges but mandatory for participants. What Rafi Farber hints at next is why this leverage trap matters far more during monetary stress.
It is interesting how this kind of leveraged casino, you could say, on the paper market really maybe brings with it a lot of different dynamics, right? And different volatility. People say how silver is manipulated, right? And in some sense, even just, playing by the rules, those rules can change. And it's definitely not a market where people are just trading the physical metal back and forth. They're, playing leverage and it turns it into kind of a casino and leads to a lot of this volatility, it seems like.
Yeah. Back when I was on Seeking Alpha and before I even started the Endgame Investor, I think this was in maybe 2019, maybe 2020, shortly after COVID. So I don't remember when, but I was hearing a lot about manipulation in silver, and I have a nuanced take on that. I don't deny that there's manipulation in silver. I don't think it's a conscious activity mostly. Every now and then you could have like a team of spoofers that get in trouble in JP Morgan, they get fined $100 million or whatever it is. That's nothing. It's just like air. It doesn't really affect much. The real manipulation is the existence of gold and silver futures themselves. That is the manipulation, because that allows people to sell more silver or gold than actually exists.
The uncomfortable truth here is that manipulation doesn't need villains. It only needs structure. Rafi Farber is reframing silver volatility as a byproduct of leverage, not a secret conspiracy. And history supports that view when paper claims dwarf physical supply by multiples often cited at 100 to 1. Fines like JP Morgan's $100 million spoofing penalty sound large, but in global derivatives markets they barely register as a cost of doing business. The deeper distortion comes from futures allowing unlimited synthetic supply, muting price signals that would normally emerge from scarcity. For investors, this explains why silver can look broken for years despite tightening fundamentals. What Rafi Farber says next clarifies why this paper dominance exists at all and who benefits from it.
And the exchanges justify that by saying, well, it doesn't matter if they have the silver. If they have the dollar equivalent of the silver contract in their account, then they can settle that in the dollar equivalent of the silver. If they have the silver, great. If they don't, at least we require them to have, if they're shorting a contract, because I had to sell a contract once. Right, but to cover my long, I had to go the other side.
This is where financial logic quietly replaces physical reality. Rafi Farber is exposing how exchanges redefine settlement to prioritize dollar liquidity over metal ownership, turning silver into a cash-settled abstraction. In practice, this means shorts don't need silver, only sufficient dollars, disconnecting futures prices from physical constraints. That framework favors institutions with balance sheet depth, not long-term holders focused on supply integrity. For everyday investors, this explains why price suppression can persist without delivery stress showing up immediately. The system works smoothly until confidence breaks. What Rafi Farber implies next is why this settlement logic becomes dangerous when silver's role starts shifting from commodity to money.
So they require the full dollar amount of that contract, even if you have the silver in your account, even if you have the warrant, right? You still have to sell a contract short to deliver the warrant to somebody. So technically, I had to short silver once, and I know what's involved to do it. The reason that it looks like manipulation is that any other futures market, let's say oil or wheat or whatever, right? Those are consumed, and higher prices for wheat, they encourage people to consume less because they want to save money, right? There's on one side you have money, which is the dollar isn't really money, but it's more moneyness than the wheat. It's more liquid. In the dollar/wheat equation, you have dollars on one side, you have wheat on the other side. So the higher the price of wheat goes, the less people want to buy it, or any other commodity like oil or lumber or whatever, right? Because these things are actually used. But for a money commodity like silver, when you have dollars on one side and silver on the other side, you have, if you're talking about industrial silver, then yeah, on that equation, the dollar is more liquid than the silver. But if silver keeps going up and up and up and up, the moneyness of silver starts creeping into people's consciousness.
This is the line Wall Street never once crossed. When a commodity stops behaving like a commodity. Rafi Farber explains that silver breaks pricing models because unlike wheat or oil, rising prices don't destroy demand. They awaken monetary demand. Historically, this shift occurred in the 1970s, when precious metals detached from industrial logic and became inflation hedges. Once silver's moneyness rises, futures mechanisms designed for consumables become distortive rather than stabilizing. For investors, this is the inflection point where paper markets lose control and physical demand reasserts itself. What Rafi Farber hints at next is why this psychological shift matters more than any supply report or CPI print.
And the money in that equation becomes the silver, so that becomes the opposite of a consumable commodity. The higher the price goes, the more people want it instead of the less people want it. And that creates a very dangerous potential for a positive feedback loop, which will spell the end of all futures markets very quickly. And so what happens then is, again, this isn't conscious, but once the silver price keeps going higher and higher and higher and higher, it locks up more and more money there, and more and more dollars at least, and then all other futures markets get whacked out, like we saw on, what was it, March 7th, 2022, with the whole nickel scenario. There's a short squeeze there. So this could happen, and not by anyone's conscious activity or conscious thought. It could lock up the entire futures market, and that's when the Comex would have to act. Not out of any malice or anything towards silver stackers, but for their own survival, which is exactly what the LME did when nickel exploded. They reversed trades because they had to. So be careful.
Definitely. I think you mentioned how you like to also focus on kind of monetary theory, right? Not just the day-to-day what's happening. You recently put out a video on your YouTube channel explaining the difference between, as you just mentioned, money and currency, or money and credit, and how a lot of people, I feel like, get this wrong.
The real danger starts when silver stops acting like a commodity and starts behaving like money. Rafi Farber is warning that rising prices don't reduce demand here. They intensify it, creating a reflexive loop that futures markets are structurally unequipped to survive. We saw a preview on March 7th, 2022, when the LME reversed nickel trades after a short squeeze threatened systemic collapse. That wasn't manipulation, it was survival. For investors, this means paper markets can be shut down precisely when price signals matter most. That risk doesn't show up in volatility indexes or CFTC reports. What Rafi Farber explains next reframes silver not as a trade, but as a monetary fault line.
They think of, the price of silver or gold going up, and we've seen that over the last couple years, and they feel wealthier, right? But in a reverse sense, it's just the dollar going down, right, in value, or other things going down in value with respect to precious metals. But first and foremost, really the dollar falling. Did you want to explain a little bit about that, and how when people are investing in precious metals, it's really a divesting from the credit system? It's not really an investment at all. It's just really getting your money, your money into real money out of the system.
Yeah, so that I did a top 10, and I would recommend your viewers to watch it. I think I did. It came out pretty well, I think. A lot of what I say subverts even what stackers like to say, like gold and silver are a store of value. I don't like that language at all. I mean, you could technically say it's a store of value, but that's just a function of the liquidity of these metals. Right? A money is just the most liquid commodity that exists. There's nothing else to it. We're overthinking it by saying that it's anything else than that. It's a thing that changes its price relative to every other thing the least. And that's why people hold, that's why it's a store of value, though value isn't a thing that can be stored. It's not, you can't put it anywhere. It doesn't like live in the atoms of a gold bar, right?
Here's the mental trap investors fall into without realizing it. Rafi Farber makes the uncomfortable point that rising gold and silver prices don't automatically mean you're richer. It often means the dollar is weaker, especially post-2020 after trillions in monetary expansion. Framing metals as a store of value obscures their true role. Liquidity, not yield or growth. Value isn't embedded in atoms. It's relative, subjective, and constantly repriced. For portfolios, this means metals aren't an investment competing with stocks. They're an exit from currency risk. What Rafi Farber explains next completely overturns how most people think about owning precious metals.
It's a subjective thing, but the material of the gold itself has people subjectively thinking what its value is changing the least relative to everything else, because the most people want to buy and the most people want to sell at the same time. Well, what you were touching on was the myth number 10, that you can invest in gold and silver, right? You can't invest in gold and silver. You can only divest your credit, go back into money, right? The only way to get out of credit is to go into money. There's nothing below. The simplest form of credit is the US dollar, because all other credit is based on the US dollar. The only way to get out of the US dollar is to go underneath it, and that is gold and silver. So it's a divestment. When you have currency, a currency is just a liability note, a liability that's a ticket for pro rata everything that's on whatever central bank of whatever balance sheet of whatever central bank issues that currency. A dollar, a euro, a Japanese yen, it all goes back to that central bank. So owning that currency, whether in digital or physical form of literally cash on your mattress, or a CBDC, if God forbid that should ever come to fruition, that's all just a liability note of the central bank. So owning currency is an investment in those central banks.
This is where the language investors use quietly misleads them. Rafi Farber dismantles the idea that gold and silver are investments, arguing they're actually exits from credit, not assets generating returns. Every currency, from physical cash to digital balances, sits as a liability on a central bank's balance sheet. That means holding dollars is effectively a bet on central bank discipline, something history repeatedly challenges. For long-term investors, this reframes metals as insurance against systemic promises, not speculation. What Rafi Farber explains next shows why moving higher in the system increases risk, not safety.
In order to divest from those central banks, the only way to go is gold and silver, because if you go higher in the pyramid, let's say you own debt, Japanese debt or treasury debt or whatever it is, that just goes higher and higher up the credit derivative, and that's like a leveraged investment in the central bank, right? So, for example, if you're gonna own gold, fine, you own gold. If you're gonna own a gold derivative, maybe you'll own GLD, which is less safe, and it's not gonna do you much good if everything goes down. But even worse, even more leverage than that would be the 2x gold ETF, like what's it called? UGL, I think. So the higher you go in the credit derivative, if you go into debt or you go into stocks or you go into whatever it is else that central banks buy, tech stocks, whatever. I think they even buy options now. So that's all an investment in the central bank. The only way to get out of it is to divest, and the only way to divest from the credit system is gold and silver, because what happens when credit collapses is that credit is only in our minds. That the credit is the invention. Money is not an invention. Money is a natural thing. That's all it is.
This is the inversion most portfolios never account for. Rafi Farber lays out how moving up the financial pyramid into bonds, ETFs, or equities actually increases exposure to central bank credibility, not reduces it. Instruments like GLD or leveraged ETFs amplify counterparty risk precisely when protection is needed most. History shows this clearly during 2008 and 2020, when liquidity vanished, but physical ownership retained optionality. For investors, this forces a hard distinction between convenience and resilience.